Coinbase's decision to terminate its free yield program for stablecoin holdings like USDC, CZ, fundamental realignment in the value proposition of centralized cryptocurrency exchanges. For years, platforms like Coinbase, Gemini, and others used yield as a customer acquisition and retention tool, positioning themselves not just as on-ramps to crypto, but as destinations where capital could passively grow. This move signals a maturation, or perhaps a contraction, of the industry's growth at all costs phase. It reflects a broader trend where regulatory scrutiny, particularly from the SEC regarding the SEC regarding the classification of yield programs as unregistered securities, has forced a strategic retreat. The exchange isn't abandoning yield, it's commoditizing and monetizing it. By gating it behind the Coinbase One subscription, they transform a universal benefit into a premium feature, effectively segmenting their user base into free tier transactors and paying tier members. This creates immediate fertile ground for competitor platforms, upholds promotion of up to 4% API is a direct and aggressive counterstrike. It's a classic market disruptor play. Identify a point of customer pain or frustration from a dominant player and offer a superior solution. The calculus for users becomes a multivariable equation. Is the annual subscription fee to Coinbase One worth the bundled benefits, like reduced trading fees and dedicated support, compared to the potentially higher raw yield elsewhere? For the small to mid-sized holder, the math may now favor the specialist yield platform. This ignites a new phase of competition, not on trading fees alone, but on ecosystem yield, a war for the sticky capital that users are willing to leave on platform. The long-term implications are profound. First, it pushes users to become more financially literate and proactive. The era of set it and forget it yield on major platforms is fading, requiring investors to actively manage where their stablecoins reside. Second, it accelerates the decentralization of finance by default. As centralized entities pull back from offering yield due to regulatory risk, the comparative appeal of DeFi protocols, despite their complexity and smart contract risk, increases. Third, this shift forces a reevaluation of what we expect from our financial service providers. Is an exchange a utility for converting fiat to crypto, or should it be a holistic financial hub offering savings, credit, and investment products? Coinbase's move suggests a prioritization of the former, bundled into a subscription model, while others may bet on the latter. Ultimately, the yield war is a microcosm of a larger battle over the future of financial intermediation. The removal of free yield is not an endpoint, but a starting gun. It will force platforms to innovate on other vectors, security, user experience, asset diversity, while simultaneously pushing a segment of users toward riskier but higher yielding alternatives. For the average investor, it's a wake-up call. The easy money era within user-friendly interfaces is over, and navigating this new landscape requires more strategy, more comparison, and a clear understanding of the trade-offs between convenience, cost, and return. Robinhood's heavy investment in prediction markets, punctuated by its CEO's supercycle declaration, is a bold attempt to invent an entirely new asset class within a mainstream retail investing app. Prediction markets aren't new. Platforms like Predictit and Polymarket have catered to niche audiences for years. However, Robinhood's integration brings them into the financial mainstream for millions of users, sitting side by side with stock and crypto tickers. This normalization is the game changer. The AI can process vast datasets, earnings transcripts, news sentiment, technical indicators, in seconds, identifying patterns and correlations a human might miss. This could, in theory, level the informational playing field, giving retail traders access to insights that were previously locked behind expensive Bloomberg terminals or hedge fund research desks. However, this power is a double-edged sword draped in significant automation bias. The primary risk is that users will conflate data processing with wisdom. The AI, as the script notes, is a historian. Its analysis is backward-looking, extrapolating future probabilities from past patterns. It possesses no true understanding, no capacity for qualitative judgment, and cannot factor in black swan events or paradigm shifts until they are already in the data. It might flawlessly identify that stocks with a certain RSI pattern have historically rebounded, but it cannot know if this pattern is about to break due to a newly passed piece of legislation or a CEO's undisclosed health crisis. Furthermore, the seamless transition from analysis to execution is fraught with behavioral danger. The frictionless ease of saying buy 2 shares of Oracle if it drops below $180 could lead to impulsive, overtraded portfolios. The AI acts as an enabler, removing the crucial moments of reflection between idea and act. There's also the question of underlying incentives. An AI built by a brokerage that profits from trading activity may, even subtly, be optimized to encourage more frequent trading rather than long-term buy-and-hold investing. The evolution of this technology will define its ultimate impact. The next step is personalized AI that learns an individual's risk tolerance, tax situation, and financial goals to provide truly customized advice, potentially acting as a full-scale robo-advisor. The regulatory framework for this is embryonic. Is Cortex offering investment advice? Who is liable if its analysis leads to substantial losses? Robinhood Cortex is a landmark step, but it ushers in an era where the most critical skill for an investor may not be stock picking, but the ability to intelligently question and manage the AI tools at their disposal. The co-pilot is here, but the human must still be the pilot, understanding the instruments and knowing when to take manual control. Tokenization is the process of converting rights to a real-world asset, a stock, a bond, a piece of real estate, a royalty stream, into a digital token on a blockchain. Robinhood's expansion of tokenized stock offerings in the EU and the growth of infrastructure players like Securitized signal that this is moving from pilot phase to scalable implementation. The core value proposition is revolutionary. It promises to dismantle the antiquated, costly, and slow plumbing of global finance. Today, settling a stock trade can take 2 days, T+2, and involves a labyrinth of intermediaries, brokers, custodians, clearinghouses, and registrars, each taking a fee and introducing counterparty risk. A tokenized stock trade can settle in seconds, peer-to-peer, on a shared, immutable ledger. The efficiency gains are staggering. Instant settlement means capital is freed up immediately, reducing systemic risk and collateral requirements. 24/7 global trading breaks the tyranny of market hours and geographical exclusivity. Fractional ownership becomes inherent, allowing micro-investments in previously inaccessible assets like commercial real estate or fine art. Programmability is the killer feature. A token can have rules embedded in its smart contract, automating dividend payments, voting rights, or loyalty rewards without administrative overhead. Securitized CEO Carlos Domingo's projection of a multi-trillion-dollar market is not hyperbole. Every illiquid asset class is a target for this disruption. However, the path is not without monumental hurdles. The primary challenge is not technological, but legal and regulatory. How does one enforce the legal rights represented by a token? If you own a tokenized share of Google, are you a legal shareholder on Google's cap table, or do you have a contractual claim against the entity that issued the token? Most current models use a sponsored structure where a regulated custodian holds the underlying securities and issues tokens as beneficial interest receipts. This reintroduces a central point of trust, but it's a necessary bridge to regulatory acceptance. For traditional finance, TradFi, tokenization is both an existential threat and a massive opportunity. Banks like JP Morgan are actively exploring it for repurchase agreements and private markets because they see the efficiency potential. Their fear, as mentioned in the context of the Clarity Act, is being disintermediated entirely. If a company can issue tokenized shares directly to a global pool of investors via a decentralized platform, what role do investment banks, exchanges, and transfer agents play? The likely outcome is a hybrid future. Trad institutions will adopt the technology to streamline their own operations and defend their turf, even as new native tokenized markets emerge alongside them. For the retail investor, the immediate impact may be subtle: access to slightly higher yields on tokenized money market funds or the ability to trade European stocks after hours. But the long-term implication is the democratization of global capital markets. Tokenization could lower the cost of capital for businesses, increase returns for investors by cutting out middlemen, and create a truly unified liquid global marketplace. It is a foundational shift, rebuilding the financial system from the asset up. While the crypto element grabs headlines, the real story is the quiet, systematic digitization of every financial asset in the world, promising a future where value moves as easily and instantly as information does today. The current U.S. regulatory landscape for digital assets is not merely uncertain, it is actively contradictory, creating a state of paralyzing limbo that stifles innovation while failing to protect consumers. The stalling of the Clarity Act, which aimed to provide a comprehensive framework for stablecoins and market structure, is symptomatic of a deeper political and philosophical divide. The issue has become entangled in wider debates about the jurisdiction of the SEC via the CFTC, the power of traditional banking lobbies, and fundamental disagreements over how to classify digital assets as securities, commodities, or something entirely new. This vacuum has two primary consequences. First, it creates a regulation by enforcement environment. Without clear rules of the road, the CC and other agencies use aggressive litigation to police the space, arguing after the fact that existing securities laws apply. This creates immense legal uncertainty for businesses, chilling investment, and pushing development offshore to more defined jurisdictions like the EU with its MiCA framework or Hong Kong. Companies operate in a gray area, unsure if today's legitimate product will be tomorrow's court case, leading to the cautious, incremental rollouts we see. Second, as highlighted, it forces a dysfunctional race between incumbents and innovators. Traditional banks, witnessing the disruptive potential of stablecoins and tokenization, are not sitting idle. Their lobbying push for the right to issue their own stablecoins and to bring crypto activities under existing banking regulations is a defensive maneuver. They aim to ensure that any new digital asset system operates on their terms with their compliance layers and balance sheets at the center. The 60-day comment period reference for banks to issue stablecoins is a pivotal moment. It could lead to a future where digital dollars are issued by Chase and Bank of America, preserving their centrality but adopting the technology. This limbo directly harms consumers. It limits the products available to U.S. residents, often leaving them with only the riskiest, least compliant options or pushing them towards unregulated offshore platforms. It also prevents the establishment of clear consumer protection rules regarding custody, disclosures, and conflict of interest. The lack of clarity on what constitutes a security means many users may be investing in unregistered offerings without realizing the risks. The path forward is messy. The death of the Clarity Act for 2024 likely means at least 2 more years of ambiguity. In this period, we will see a patchwork of state-level regulations, continued enforcement actions, and companies designing products for a regulatory future they must guess at. The likely outcome is not a single legislative big bang, but a gradual court-driven clarification of existing laws combined with smaller targeted bills addressing specific issues like stablecoins. For participants in the market, this means operating with maximum caution, assuming the strictest regulatory interpretation, and planning for a prolonged period of uncertainty where legal strategy is as important as product strategy. The great financial infrastructure rebuild is happening, but in the U.S., it is constructing its foundation on shifting, contested